Hello guys, welcome again to Investment Tutorial Hub. In this video, I'm going to answer the question, what is a bond? I'm sure you have probably come across the word bonds before, either in the news, online, on the pages of the paper. I can also guess when you try to figure it more, they just try to confuse you more with all the financial jargons you are not interested in. Remember, we are talking about types of investments. So, the first type of investments we are going to talk about is bonds. So, we'll go back to the question again. What are bonds? A bond is essentially a loan from you, the investor, to a corporation, a government entity, or other organization. Simply put, bonds are simply a term for loans that you give to either the federal government, the state government, or companies. Another question, is it a document or what is it? Well, a bond is simply a piece of paper issued by the borrower, for example, the state government. That paper will state the amount borrowed from you, the tenor, which is the number of years with which to repay, the interest rates, and the repayment period. Yes, that's a sample of what a bond looks like. Now, for you to fully understand the bond paper or documents, here are few key terms you will need to know before you want to start venturing into investments in bonds. One of the terms you need to know is maturity. Maturity is a specific date by which your principal loan must be repaid. Another time you need to know is face value. This is how much your bond will be worth on its maturity date. You know, we have defined maturity, the dates by which the amount will be repaid. Now, the face value is how much the bond will be worth on its maturity date. This is also called sometimes par value, and it's used to determine the amount of the interest payment you will receive until the bond matures. Most bonds are issued in multiples of 1,000. Another word we hear is coupon. The coupon is the annual interest rate paid on your borrowed money. This is generally paid either quarterly, semi-annually, but it is stated on the bond document. Another word you hear is yield. Yield, this is the return an investor can expect to receive from the bond interests. Of course, yields are basically untraded bonds. Traded bonds, we'll discuss more on this later. Then we have also what we call callable bond. This type of bond gives the issuer the right to pay the bond holder back earlier than the full term of the bond. You know, the issuer can be the federal government, the bond holder can be you, the investor. So the callable bond gives the government, for example, the right to say, okay, instead of waiting for 10 years to pay you back our money, we can pay you before the 10 years or 5 years, as the case may be. And that's what we call the put bond. This type of bond gives the investor the right to demand early repayment of the principal, effectively cancelling the loan. That is you, the investor, are saying, I won't wait, I will cancel it. Give me back my money. Then there's what we call the floating rate bonds. Not all bonds are fixed income bonds. Some bonds interest payment change according to the short-term benchmark rates or even the price of a commodity. Then there's another term called the zero coupon bonds. These are bonds that have no periodic interest payments. Instead, the cash returns from these bonds come at maturity. So at the end, at the maturity period, both the interest and everything will be paid to you. Now, what are the different types of bonds? There are various types of bonds that all carry different level of risk. The main types of bonds are one, the federal government bonds, which can be called treasury. They are bonds issued by the federal government and sold to investors as a way to fund government spending. We have what we call the municipal bonds, sometimes called munis. Municipal. These are bonds issued by states, cities, and other government entities to raise funds for public projects like new schools, highways, sewer systems. Then we have the corporate bonds. Corporations, organizations, companies may issue bonds to fund large capital investments or a business expansion known as corporate bonds. Now, another question, how do investors make money on bonds? Investors, you, how do you make money on bonds? Well, there are two different ways that investors can earn money by investing in bonds, apart from waiting until the maturity period to collect your original investments. One, collection of interests. Bonds will naturally pay you interest throughout their term until they reach maturity. So by making your initial investment, you'll be collecting bonds either quarterly or semi-annually. Second way, what we call capital gains. Many bonds are not held up to maturity. The time period of bonds maybe 5 years, 10 years. As an investor, you may choose to sell your bonds before it reaches the maturity date. When you sell a bond for more than you paid for it, that is known as capital gain. Let's say you purchased a bond for 10,000 naira and you sell it for 15,000 naira. That 5,000 naira difference is known as capital gain. Another question, why do governments or companies issue bonds? To answer, let's take a look at the following bond prospectus. Bond prospectus. Yeah, so there on the screen. Bond issued by FGN, that's federal government, with a par value of 10,000 naira on January 1, 2022. The bond has a 10-year term with a maturity date of January 1, 2032. The coupon rate is 4%. Coupon payment has been paid semi-annually on January 1 and July 1. Well, if you have been following this video from the start, you already know the meaning of these terms in the above prospectus. Coupon, maturity, you already know these terms. Now, if you purchase this bond with the least amount, let's say 10,000 naira, you as an individual, that means you have given loan to the federal government, 10,000 naira. So now let's assume that 1 million people subscribe to this bond by paying the 10,000 naira each. This amounts to 10 billion naira already. So government have raised fund. So your guess is as good as mine. Why do companies or government issue out bonds? Another question is, how do I invest in bonds? Bonds can be purchased either through the primary or secondary markets. The primary market is where you buy bonds that has just been offered by the seller, like the government, just like buying public offer. The secondary market is where you buy tradable bonds, that is, bonds from the bond market, just like buying shares in the stock market. Bonds traded in the secondary market are usually done on the floor of the Nigerian Stock Exchange or over the counter, what we call OTC, through the PDMM. PDMM means primary dealer market maker. Bonds sold in the primary or secondary market are bought through PDMM. PDMM are operators licensed to buy and sell bonds. You get the application form there. You fill it in, include your check in full for the amount you wish to invest. You can invest as much as you can, from 10,000 naira to 1 billion, depending on your capability financially. But the minimum is 10,000 and multiple of 1,000 thereafter. That's once you buy 10,000, you can now add 1,000, multiples of 1,000. The bonds purchased are confirmed through issuance of depository or issuance of certificates. The depository is the CSCS, what we call Central Security Clearing System, an online storage for securities such as shares and bonds. Another question: how do I get my interest? Interests on government bond are paid semi-annually. Some are also paid quarterly. And if it's semi-annually, some are paid in June and December or January and July. And payment is made through issuance of checks or warrants, similar to the dividend warrants you get. So with this, I'm sure when you hear the word bonds, you already know what we're talking about. So that's all now for the investment type bonds. Stay tuned again on our next video as we discuss other type of investments. Cheers.